What's going on? Welcome to my channel. I am the covered call guy, and my YouTube goal here is to create $120,000 in annual passive income using covered call ETFs. Of course, subject to change. I read every comment, even though I don't reply. Just know I try to react and I'll reply to everybody, and I do apologize. So leave your opinion and options below, and I will take everything into consideration. So thank you very much for that. All right, my projected annual dividend / options income is $82,000 a year, 6.8K a month, 1.5K a week, $226 a day, and about $9.42 per hour. Okay, legal disclaimer before we start this content. This content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own. It may be inaccurate or incomplete or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot, some random clown you found on YouTube, and I could be completely wrong. Now, before I go and show my presentation, for those who are been around, I'm going to be talking about the only weekly payer I have. So right off the bat, that should probably give you an idea. And for those who are new, man, this is going to hurt. For those who are new, you're going to probably watch my annual dividend and everything else drop. I do update this at the end of every month. Obviously, there's no point of updating it every day or weekly. That just makes no sense, and that's just too repetitive. So at the end of every month, I will try to update this either February 26th or February 27th. And hopefully, if it drops, it's probably because of this weekly payer I'm holding. Hopefully it doesn't drop too much, right? I'm trying to reach my $120,000 year goal by the end of 2026, pushing maybe early 2027. But with these payouts right now, I don't know. But anyway, let's get started. This is going to be talking about my MAGY holdings. This is my MAGY payout crash, right? So I'm going to be doing my forensic report on February 2026 distribution, right? And for those who own it with me, we feel the pain, right? We are feeling the pain, and we're going to be asking ourselves why our and your distribution just dropped to 29 cents, all right? Let the investigation begin. Okay, let's look at the crime scene, all right? February 2026 distribution, right? What took place? This is the event. I'm just going to go straight into it, right? Digging into the numbers. The first week of February 2026, the fund announced a payout of just 29 cents per share. What the heck is this deviation, right? This isn't just a small dip, okay? Because for those who own it for at least 3, 4, 5, 6 months now, right? We were getting paid a nice 30s, mid 30s, sometimes high 30s, right? So this is not a small dip. So this is a pretty precipitous decline, right? It's pretty significant deviation from the trends I've been tracking over the last quarter. And of course, our job is to find out why, right? When the payout starts to decline like this, we have to find out why, right? My verdict, of course, it's a massive anomaly, and we have to find out what is happening, right? All right, so it is not a bug. It is a feature. Why do I say this? I'm going to say my central thesis is simple. This is because I think the contraction was deterministic. I think it was directly the result of a volatility crush post-earning. Remember, the entire week of February was earnings, right? I don't think the machine is broken, nor the environment was that bad. The environment has changed, but I don't think it's completely broken yet. Hopefully never. I'm looking at it from a reality standpoint here. I'm looking at operational feature, not a glitch. So I'm not too worried just yet. Okay, let's look at the secret sauce and how it happened. First is reduced capital, right? This is called NAV erosion. The price of the underlying asset dropped, shrinking the base I can write options against. This is the MAGs, right? Collapsed volatility, so cheap options, right? The fear premium vanished after earnings, meaning I get paid less for the same risk. And of course, systematic issue, right? This isn't just MAGY. What I'm finding out from my analysis confirms that this phenomenon was basically systematic across the volatility harvesting field environment, right? And the calculation is, of course, lower NAV plus low volatility equals lower payout. All right, so let's check in the receipts. Let's look at the numbers, right? So I verified the official records from the Cboe exchange and Roundhill investment. All right, so I just want to establish a definite baseline for my analysis. That way I kind of have a base to go off of. All right, so these are the precise figures, all right, and it's critical because it serves as a terminal data point, okay, in a sequence of declining payouts that I noticed starting in mid-January. So let's look about pretty much from declaration date of Thursday, February 5th, ex-dividend date February 6th, right, payable date February 9th, and distribution 0.29 cents, right? This is the proof. Official records confirmed. It has dropped. I got paid, and was I happy? Of course not. But I am looking at the bigger picture, right? The step down trend. Look at this. If you hold it, look at it. We need to know, why did it peak and why it's dropping. The peak was December 19th. This is the peak. And as you can see, January 15th, it got lowered. January 20th, 29th, it got lowered. And then February 6th was the crash down to 29 cents. So basically, right, whoever hold it, we saw a 12.6% drop in a single week, right? So this is the trajectory, right? Unmistakable from peak holiday volatility to post-earning hangover. The pattern here is that yield compression in real time. We're seeing it within just a week. All right, how the sausage is made. Of course, we got to look at this and we have to understand it, right? I need you to understand the math behind your money. MAGY does not rely on organic dividends, right? It manufactures yield. This is the formula for it, right? Look at it. Understand the formula. That is the income available for this distribution is mathematically derived from premiums collected. If the input changed, the output changes, right? Premium is the variable term here. It collapsed. The mechanism is just math, not magic. Understand the math and you'll get your answer there. All right? Problem number one is, of course, the shrinking pot, right? I call this the denominator effect. Basically, we have to look at the underlying asset, which is MAGs, suffered a marked correction, right? Market data shows mark traded down to 63.11, right? If I write a 1% option on a $66 stock, I get 0.66. If it drops to 63, I get only 0.63, right? That is a lower NAV, which is net asset value, inherently caps the absolute dollar amount I can harvest, right? Capital-based contraction here. That's what's happening. All right, problem number two is the volatility crush. I think this played the biggest part. This is the potent driver, right? Option premiums are priced of uncertainty, right? When uncertainty is high, premiums are expensive. But once earnings were released, the event risk dissipated. Data shows Apple's IV dropped to 23, right? The market exhaled, right? Calmed down a little bit. IV collapsed and the premiums evaporated, right? No one was willing to pay for it anymore. The mechanics is that no fear means no premium. For those who are new, I talk about this a lot. All right, the timeline and how we got here. This is just my take on it. Of course, take it with a grain of salt. November 2025, right? This was the bullish baseline. FOMO trading payout was about 37 cents per share. Easy money all day, every day. We'll get back up there. It's a cycle. I can almost, I'm not going to guarantee anything, but, right? We'll get there. Fingers crossed. We'll get there. All right, December 2025, rebalancing happening, right? Volatility stayed high. Payouts was about 0.36. January 2026, this is where divergence started to happen. All right, pre-earnings ramped, stocks wobbled, but IV held. Payout pretty much kind of went up and then crashed, right? This is pretty much as it goes up. February next month, it crashed. This is the crash. Price correction plus IV crush plus sector rotation. Remember I talked about SCHD? If you didn't watch that video, go ahead and watch it, right? And pretty much kind of a sector rotation here, right? This was the journey, right? From FOMO to defensive recalibration. Should you get scared? Am I scared? I'm going to say no, all right? Is it just us? I'm going to take an example, MAGY versus QDTE, right? MAGY, right? That's us. Right, took a 12.6% drop versus someone like if you're holding QDTE took a 26.4% drop, right? When I compared MAGY against its sister fund, the closest, I guess the closest, right? QDTE, the NASDAQ, pretty much QDTE collapsed by over 26%. And at least this proves the issue is systematic across the tech sector, not a failure of MAGY's specific management. At least not yet, right? My verdict here, still, I'm holding out on systematic issue, not idiosyncratic problem. All right, and of course, let's talk about the tax truth, return of capital. I dug into some 1981 notices. It looks like the recent distribution are estimated to be 100% return on capital. I am happy. All right, so in the bear market, this could get dangerous if the fund continues to pay out cash while the asset drops. It accelerate NAV decline. Although I'm happy for the 100% rock, I do have to keep an eye on this. All right, so basically, you are getting your own principal back. The warning here is avoiding eating the seed coin. Right, you need the seed to grow. Right, tough love here is the management call. Right, reducing the payout was a prudent risk management decision to preserve the structural integrity of the ETF. Of course, this is my opinion. I believe the managers chose to lower the yield to avoid liquidating assets at depressed prices. They are preserving the capital base for future recovery. If my opinion is right, this will definitely be a ultra long-term hold, and probably I'm going to add more money to it. So this is right now just a hold for me. The strategy, at least I think what they're doing, is capital preservation over yield. So good work on that if my opinion on them is correct. All right, let's look at the anchors, Meta and Amazon, right? So I identified the specific heavyweights that dragged us down. These two were the primary anchors. Meta dropped to 647 post earnings. So this was a sharp drop, right? A sharp drop is the worst case scenario for a cover call fund. Amazon, right? Faced selling pressure, right? Dropping nearly 7.5%. These are the culprits, right? Negative earning reactions. This is just how the game is played here. Right? The hero, though, Nvidia, to the rescue. But why wasn't it worse? Nvidia. That's the answer, at least I came up with. While the other giants crashed, Nvidia's earnings aren't until February 25th, 2026. That means its volatility did remain elevated. The premiums from Nvidia calls provided the floor, right? That kept the payout from collapsing completely. This is the savior. Was the volatility buoy. All right, what's next? These are my predictions. Nvidia is the catalyst here, right? IV will spike before February 25 earnings. So I do expect the payout to rebound to roughly at least 0.32 or at least in at least 30-cent range temporarily. This might be the new normal, so expect it, right? Post earning, the event risk is 0. I expect a baseline of 0.29 to 0.31. Call me out if I'm wrong. You know, hopefully I'm not, right? All right, the risk. But, right, of course, we have to look at the underlying. If MAGs drop below the $60 support, distribution could compress further towards the 25 cents range. And this is where I go, okay, what do I do now? Should I continue to hold it or do I pivot? Right. So my forecast is normalizing phase incoming. Right. Is this the new normal of 25 cents? Does it hold 25 cents? Because if it does, then I'll say, okay, it could rebound. I have no worry about that. But if it keeps dropping, then I have to start looking at exactly what the active management is doing. Are they putting out any news? What are they doing? Right. My final verdict, of course, the reduction of 29 cents is rational. At least that's what I tell myself, right? It is a mathematically consistent outcome of the environment. It is a signal of normalization, transitioning from easy money to more a grind phase, right? And to be, of course, let's be real, right? I hope this is just rational math at work, because if the managers are purposely paying out high distribution just to keep us MAGY holders happy while the ship pretty much, takes on water, we're in big trouble. Yikes, right? I'd rather take a pay cut today than find out they've been paying me with my own money with serious NAV decline. All right, so we do have to be looking out for the payout and the NAV, right? My takeaway right now, don't panic. I think it's just math, hopefully, all right? Because we're going to at least put a stop loss on what you're willing to lose. That's the best advice I can give. If you bought it at an all-time high, you haven't been dollar cost averaging down, and if you're just done dollar cost averaging down, know when to get out. Know your price. All right, thanks for watching. Smash that like button, subscribe for more forensic financial breakdowns. Of course, I'll be doing all of my own holdings, right? Comment below. Are you holding or are you folding Maggie for us Maggie investors, right? This is my call to action, and it's to join my squad. And when I say squad, my comment section and my channel. I don't have anything else. I really don't have like no Discord or any other group. I'm just focusing on YouTube right now and you guys, the community. So thanks for watching. Stay tuned. Catch you guys on the next.